One of the things that was not surprising to see in the best performing for not only the fourth quarter, but also the year was your favorite asset class, crypto.
Yeah, let's just get the elephant out of the room. Okay. I mean, we've got crypto funds out the wazoo putting up monster numbers. I mean, this is like Randy Moss. Have you ever seen that stat line? 3 catches, 340 yards, and 3 touchdowns, or
Yeah.
something like that. I don't even think that's
Ethereum up
possible.
300%,
Yeah.
leave another three for you. Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on January 5th, 2024.
Happy New Year to you, my friend.
Happy New Year to you, Miles. Yeah, so my name's Ian. We're here with Miles again this week. First podcast of 2024.
That it is.
Or I feel like we keep saying a lot of last time it was last podcast of 23, first podcast of 24. We got to stop it with these isms.
It's that time of year.
It is. It is that time of year. Yeah, certainly a pretty interesting time of year coming back into the market. We were kind of got lulled to sleep, I feel like, over the last couple weeks of 2023. I don't know if that's because of all the food or because of just the lull upwards that markets were kind of showing us, but not the same movement over the first few days of the year.
Yeah, it's been a pretty rude awakening, I would say, as we kind of come back into 2024. Unfortunately, new year, everyone's happy about that. Probably not as happy about the performance we're seeing in the portfolio at the moment.
Well, they could be just happy enough to take some profits, right? I mean, they're pretty happy about last year. They want to take some profits for this year, right?
That's true. That's true, but it hasn't translated into good performance numbers, at least for the week. Pretty much everything is down in the red that we typically look at. Only thing probably of note is going to be the US dollar. That's up about 1.5%. Besides that, domestic equities across the board, S&P 500, Nasdaq Composite, Russell 2000, whatever you want to name, they're down probably over about 1.5% or so. Russell 2000 is down about 5%.
Wow. Yeah, but we were talking about, I think the last time you and I were on here, we were talking about everything was overbought.
Yeah.
Right. Overbought, becoming more overbought, especially the stuff that had done really well throughout last year. You get into this year, you have the Nasdaq sell-off for consecutive days. You have big tech sell-off for consecutive days. You have those areas like small caps that had done so well. Like you just mentioned, down 5%. What'd you say? They're up over 20% in the last 6 weeks of the year?
Yes. Since their October low, they're up about almost, let's just call it 25%.
Right. And to see them go up that much in such a short amount of time and then pull back 5%. I guess everything's relative, right?
Yeah, let's be honest. This was needed. We've been calling for this for quite some time. Probably a little bit early here at the Dorsey office, but nonetheless, we've been saying we need to pull back for a long time, and this is healthy. Yeah. We have to kind of emphasize that this pullback, as long as we kind of find some relative support nearby, and we can kind of get lulled back into that upward action as we move through January, this is pretty healthy, I think.
Yeah, I think it could be. And I think it could certainly depend on the name too. And when we're looking at different names across the market, right, we do a piece at the beginning of each quarter that looks at the best and worst performing funds across different classifications of the market for the last quarter and for 2023 as a whole. So we did that on Wednesday's report for those that are following along, those that are subscribers to the platform. We break it up by asset class and then by kind of classification within asset class, at least on the domestic equity side. There were some I would say a few things that were more surprising, or at least that I wouldn't have necessarily thought of to see in the best performing and in the worst performing areas in a few different asset classes. One of the things that was not surprising to see in the best performing for not only the fourth quarter, but also the year was your favorite asset class, crypto.
Yeah, let's just get the elephant out of the room. Okay. I mean, we've got crypto funds out the wazoo putting up monster numbers. I mean, this is like Randy Moss. Have you ever seen that stat line? 3 catches, 340 yards, and 3 touchdowns, or something like that. I don't even think that's
Ethereum
possible.
Up 300%. Leave another three for you.
But yeah, so that's the elephant in the room. Crypto has put up a massive 2023, pretty rocky start to 2024 with some of the some of the spot ETF news or maybe lack thereof.
Right.
But that's something to keep monitoring. That's been pretty much priced in that approval. So anything less, I think, to start 2024 was a bit of a disappointment for the crypto holders, but we'll see what's in store.
Right, but I mean, you saw Ethereum, that Ethereum ETHE, Grayscale Ethereum Trust, up 75% in the fourth quarter.
Yeah.
And then VITO, that ProShares Bitcoin Strategy ETF, up 52%. Pretty sharp rallies, I would say. So seeing them pull back 5 to 10% over the first few days of the year, as we were talking before, everything's relative, right?
Yes.
And some other kind of interesting areas. I know we were we were looking at a few of the funds. I feel like we didn't talk about ARK a lot last year.
We did.
They had such a transformative year in 2021. Got a lot of flack, I think, in 2022, that kind of time frame, right? Once things kind of didn't go so well for them. But very strong returns throughout a lot of this year for some of those funds.
Yeah, there's been a couple that fintech there towards the top of our list.
RKF, right?
Yeah, there. And then ARK-K is just going to be, you and I were saying, their flagship is kind of like their main fund there, ARK-K.
Right.
That looks pretty strong, pretty strong in 2023.
So, I mean, when we're looking at performance for that fund over the past year, ARKK, it's up 60% over a trailing year. So since January of 23, up 60%. It's still down 68% from its February of 21 high. Yeah. So that is, I mean, I know you and I were talking about it. We were talking about it with some others in the office earlier as well. That really puts it in perspective of what kind of relative performance is. You can have something up 50, 60% in a year that's still almost 70% down from its all-time highs. I mean, it just shows you how bad of a time it had in 2022 and how much work it needs to do to get back to where it was. So, I mean, current chart picture, like you were talking about, pretty solid. You're looking at what, 6 consecutive buy signals, rallied up to a new multi-year high up there at $54 right at the end of last year.
Right.
Pulled back sharply to start this year, and now you're up 1.4%, at least at the time of this recording on Thursday. Got into overbought territory, pulled back from that overbought territory, hasn't fallen to that first support level at 47.50. Strong fund score. Names like this, I mean, that's kind of like what you were talking about. We needed that for some of these names that had been up so high.
And I want to emphasize something that gets a little bit outside of the technical jargon that we typically go to. Emphasizing how important it is to kind of protect from that downside.
Right.
You can have an amazing year. I mean, 60% is nothing to turn your nose at, certainly. But when it comes on the back of such a poor year, you need to double, triple, quadruple your performance in 1 year to just get back to where you were. So it's just as much about playing defense as it is sometimes about playing offense with a lot of these funds. I think that's something that gets lost. You just see the performance metric and you don't really think, okay, well, you know, in just 3 years, where we've come from. But I digress. That's maybe a topic for a whole nother podcast.
Yeah, no, I think it's an important topic, right? And it's an important thing to think about, especially when you're looking at some of the performance for these. I mean, you're looking at, well, maybe when people look at Ethereum, they don't think it can go up forever. But when you look at some consistent,
they do think.
Some people might. But when you look at the consistent improvement we've seen throughout a lot of these names, you're like, that has to continue forever.
Yeah.
It doesn't, right? And so that's a very good point, that a lot of times when we see the best performing areas in 1 year are typically not the best performing areas in the next year. And the worst performing are typically not, well, sometimes not the worst performing, but we see mean reversions happen from a broader long-term performance perspective frequently. And that's why we look at all the sector rotation and asset class rotation and everything else, right?
Speaking of that, not to cut you off there, but talking about some rotation that we've seen, maybe to another ARK fund, maybe just to another broad sector we can chat about for a second, is maybe the financials group.
Right.
Financials group have kind of picked it up. That's, of course, come along with a lot of the small cap performance. Those regional banks got hammered throughout the course of 2023 with the whole regional banking crisis, of course, we've mentioned at some point. But that sector has really seen some improvement, not only within Valley. I think it's one of the sectors on the asset class group scores page. For those of you who aren't aware, those are two of our kind of asset ranking groups that we've got on the platform. But it's got the highest score direction there too.
Yeah, I mean, looking at that, you got 3 representatives. You count that fintech innovation fund from ARK. 3 representatives in the top 10 for the fourth quarter from the finance sector. KRE, I think, is one of the more sharp rallies that we've seen for that going back for a little while. I mean, that fund has not seen a lot of movement throughout 2023. I think it's one of the most picturesque bearish triangle patterns you're ever going to see. If you go back and look at that March of 2023, I mean, it is very picturesque bearish triangle pattern there with 1, 2, 3, 4, 5, 6, 7 columns resulting in that sell signal that ultimately led to another large drop, 25% drop from that point. Very different picture to end the year. We saw 2 sharp rallies higher, a little bit of a pullback in those, like we've seen for a lot of other areas, but a much improved technical picture. 3.72 fund score with a 3.33 score direction. So that just shows you how far it's come.
Yeah, right? And it's nice. I mean, to be honest, we've been asking throughout 2023, hey, can we get some other participation? The core has been nice. It's nice to just own SPY, and it's nice to just own the Qs for the whole year and watch them go up. But we really need to say, around the office, we call it the generals versus the soldiers, right? It's nice to see some of your soldiers, some of your smaller regional banks, some of your areas outside just large cap tech kind of rejoining the fight, if you will. So seeing that pullback, constructive, nonetheless, and we'll see where things head. But it's a pretty good looking.
Yeah, and to what you mentioned, I mean, the whole last year, everyone talked about the Nasdaq 100, right, up 50% plus for the year. You have 25% plus for the S&P. Small caps just did not do well for most of the year. Value did not do well for most of the year. You look at the domestic equity broad performance rankings. What do you have in one of the top 10 performing small cap value, right? I mean, so we saw those areas in the fourth quarter last year really rally sharply. You need to see some back and forth action to get chart actually gets relative strength improvement, though, right? We straight column indexes up are not good for relative strength improvement. You need some kind of chop around. You need, as we say, some time to hand the baton off, but that is going to end up happening between some of these different sector and style classifications that we see playing out throughout the rest of this year. So that's definitely something that we'll continue to kind of keep an eye out on as we move through the rest of 24. But Miles, I know that there are some other areas within outside of maybe the domestic equity space, but still an area that we might have hit on as frequently throughout the past year to 18 months is energy, commodities, right? Oil, crude oil.
They move around quick, so they're a topic of conversation.
They are. They keep us on our toes for sure.
But no, the group commodities specifically has fallen within our broad rankings, and it's really due to energy. Like you just mentioned, we've seen a lot of energy weakness over the course of the fourth quarter and kind of to start 2024 so far. So we've seen that kind of fall within value rankings. Just about a month ago also, when the last time we were on a call, within Dolly broad rankings, domestic equities, commodities, and international equities, weren't they like within 4 signals of each other?
Yeah.
We've seen that kind of rotate out of favor. So commodities falling out a little bit. Precious metals, though, no, we didn't plan to talk about this. They seem to be talk about that passing of the baton. Gold hitting all-time highs as energy is kind of rotating out. So precious metals seem to be on the kind of the up and up.
Right. You had a few different gold funds up 10, 15% throughout the course of the fourth quarter. You had oil and agriculture down in the bottom of those performance rankings. So, I mean, that rotation, I mean, silver also was kind of the sleeper, I'd say. They didn't get as much headlines as gold, but the SLV, iShares Silver Trust, up 7% over in the last 3 months of 2023. Not too shabby for silver there.
Yeah, also nice to see, just looking at the chart itself, or looking at that kind of ETF performance chart. Copper, CPER, is in that top one. Old adage is you like to see copper doing well. It's kind of an industrial metal, so when it's doing well, there's a lot of kind of practical uses for the metal. So when it's doing well, typically economy is doing okay.
Right.
Nice to see that up there as well. Certainly don't like to see that towards the bottom, which it's not. So
right, when you get a rebound from that, that's typically can be a good sign moving forward. So hopefully that'll continue to stay true as we head through 2024. Some other areas, I think, I mean, I know we didn't plan to talk about this either, but I was looking at some of the fixed income funds yesterday, and keep in mind all of these performance chart, whether we'll show a few of them on the YouTube channel, but we also follow along on the platform. But looking at total return data, obviously, especially important there in the fixed income representatives. But you have the PIMCO 25 plus year zero coupon U.S. Treasury ETF, ZROZ, up almost 20% in the last 3 months of the year.
Yeah.
I had to double check I was looking at Jamie, who handles the fixed income deal yesterday. He had to double check that to make sure that performance was correct on a total return basis looking at it. That's pretty shocking to see, and not something I think going into the fourth quarter that you could have guessed.
We would have expected.
Right, yeah. Right.
Yeah. Well, that's what you get with the long duration funds when you see rates cooling. I think, quite honestly, if we're going to ask for my call, I think we've probably overdone it a little bit when it comes to rate expectations for 2024 in terms of the rapid expectations for cuts. We'll have to see where that goes, and that could have an impact on some of these fixed income names.
Yeah.
But yeah, to actually answer your question, that is crazy to see. That maybe the 60-40 portfolio isn't quite dead.
Right, and there wasn't a single fixed income representative that we looked at on our screen that showed a negative return over the last 3 months of the year.
Yeah, that's even more crazy.
Also pretty crazy. There weren't that many negative returning areas across most of the market. You didn't have that many in the all ETF rankings, and where most of them came from was commodities and some areas in international equities, specifically China.
Yeah.
Right. I mean, it's hard to talk about poor performing areas and not hit on China in the international equity space. I mean, you have pretty much all of the worst performing areas throughout both the fourth quarter and on a year-to-date basis. I think 7 out of the 10 were China focused in the fourth quarter, 6 out of 10 were China focused for the year. Just a lot of weakness from that area, but consistent weakness, so allowed more momentum-oriented exposure to stay away from that.
And that's where I was about to go. We talked in our weekly rundown with our portfolio manager, John Lewis.
Right.
He always highlights that, or it has not always, but it has been highlighting that emerging markets momentum spread for the past couple of months because, hey, we've just been avoiding China. Unlike a lot of these other emerging markets, that's a pretty big weighting.
Right. It's like 30%, 30 to 35% of most broad emerging representatives. You kick out that's done so poorly, and not too bad.
Just by, again, going back to something I called out at the very beginning of the podcast, by avoiding the losers and avoiding those ones that are continuing to fall, like a big drop for RKK, for instance, you can play a bit of defense and actually make your portfolio look pretty decent.
Yeah, and then staying in some of the winners too. So I mean, we were talking about before, when you're looking at consistent leadership in the international equity space, I mean, Mexico has been one of the most consistent leaders we've seen ever. I mean, you look at our broad NEW country index matrix rankings, which we won't have up, but just for background purposes, Mexico has maintained a position in the top 10 out of 42 countries longer than anything else that's in the top 10. It's had the longest stint of anything we've ever seen in the top 10 over the past 3 or 4 years since we've been tracking it. So it's just very consistent. It's not up at the top of the performance rankings on a quarterly or on a year-to-date basis, but hey, fourth ain't bad.
Yeah, and I want to emphasize quietly, right? In the dollar rankings, over on asset class group scores, Europe is getting a lot of attention. Right? Latin America has been there for quite some time, like you mentioned. So quiet, and that's okay to be quiet. You don't always have to, kind of be storming forward, but nice to see that there too.
Yeah, I mean, you look at some of those areas like we were talking about with Mexico, the EWW is a fund we were talking about there, fourth best performing international fund in the fourth quarter. Pretty strong looking technical picture on its default chart. A positive test of its bullish support line, bounced higher, rallied sharply higher up to 69. You get a pullback down toward the middle of the trading band. Their strong fund score. And then Brazil, EWZ, similar strong picture with a pullback closer toward the middle of its trading band. Latin America could present some interesting areas to look toward if we continue to see that consistency heading down the rest of the year.
Yeah, another thing I want to emphasize, a lot of clients will call in and say, hey, this thing's got a 5.8 fund score. How much more can it possibly go up, right? And it's important to emphasize something like EWW, that Mexico fund there, it has been above, except it had a brief stint down there where it traveled below, around 3, not necessarily below 3. But it's been above 5 for the better part of or actually above like 5.75 for the better part of like 52 weeks at this point, right? So you can sustain your performance there. That's another thing to emphasize, right? Just because you're there doesn't mean the runway is close to over.
Right.
You can stay there, and that's just as impressive.
Yeah, it's similar. I know Chuck's done some work on this on the technical attribute rankings, is that he's looking at separating off each of the attributes, 0 to 5, 0 is the worst, 5's the best, and see how does each attribute perform, and then how do they do coming from different areas. So like 5's do well, you want to the higher the better, 5's do the best, right? But it's interesting that you actually are better off trying to catch a rising 4, hoping it goes to a 5. Typically is not as good as catching something on a pullback that might have fallen to a 4. So when you're trying to get cute, I guess, with a lot of the attributes in the fund scores, it can often, or sometimes could work to your detriment, but keeping it simple is really the thing that you want to look toward. The higher the better. 5.71, not too bad for Mexico there.
I agree.
So, I mean, I know that there were several other kind of areas that we could look at. We can run through all of the cryptocurrency funds if you want to. If you want to,
we could, but I think I'll save the audience.
We'll save that maybe for another podcast. We'll see if we get another 300% from Ethereum this year, then we can dedicate a podcast to that. So
sounds good. You can have me on as a special guest.
But no, I think with that, I think it's been not necessarily the first couple of days of the year that many would hope for, but I think a welcome first couple of days of the year for much of the stuff that we're looking at. Shaping up to be a lot of movement throughout the next several weeks, months, certainly on a year basis. I hope not as much movement as we've seen over the past couple of years. We'll see if we get a little bit quieter 2024.
That'd be nice.
That would be nice, yeah. But to everyone joining, regardless of the movement, we'll be sure to come back and keep you updated on a weekly basis here through this podcast. If you have any kind of thoughts, suggestions, ideas, shoot us an email, dwa@dorseyright.com. We'd love to hear from you. Even if it's all just bashing us there, certainly we'll love to get any kind of feedback we can get. So dwa@dorseyright.com is going to be that email address there. Miles, thanks for hopping on this week. Everyone, thanks for tuning in this week, and we look forward to talking to you again next week.
Have a good one.